This rate cut by the Bank of England wasn't about growth, it was about damage control. It affects mortgage payments, savings, inflation, and sends a warning signal about the UK economy that global markets are already reacting to. In this briefing from Economic Global Brief, we explain why the Bank of England cut rates, what it reveals about the UK's financial position, and how this decision could affect your money, even if you don't live in Britain. Section 1. What the BOE did. The Bank of England adjusted its benchmark interest rate after months of restrictive policy aimed at controlling inflation. This decision signals a shift in emphasis, from fighting price pressures at all costs toward protecting economic stability. Central banks use interest rates as their primary tool to influence borrowing, spending, and inflation. When rates stay high for extended periods, they can slow demand, reduce investment, and weaken growth. By moving rates lower, the Bank of England acknowledged that inflationary pressures are easing, while economic momentum remains fragile. Section 2. Why the BOE cut rates. Several factors pushed policymakers toward this decision. Inflation in the UK has declined significantly from its peak, reducing the urgency for extreme monetary restraint. At the same time, economic indicators suggest that growth remains weak. Consumer spending has been pressured by high living costs, while business investment has slowed under the weight of expensive borrowing. The Bank of England faces a narrow path, easing financial conditions enough to support growth without allowing inflation to return. This rate cut reflects confidence that inflation risks are becoming more manageable, but not eliminated. Section 3. What this means for ordinary people. For households, the effects are mixed. Borrowers, especially those on variable-rate mortgages or refinancing loans, may see some relief as borrowing costs ease. However, for savers, lower interest rates can reduce returns on deposits and savings accounts. This creates a familiar trade-off. Policies designed to stimulate spending and growth often come at the expense of savers. The overall impact depends on how quickly banks pass on rate changes and whether inflation continues to slow. Section 4. What it means for the pound. Interest rate changes also influence currency markets. When a central bank cuts rates, its currency can weaken as investors seek higher returns elsewhere. If UK interest rates fall relative to those in the United States or Europe, the pound may face downward pressure. A weaker currency can raise import costs and affect inflation, but it may also support exports by making UK goods more competitive. Currency movements depend not just on this decision, but on how global investors interpret future policy direction. Section 5. Europe and global markets. The Bank of England's decision does not occur in isolation. Global investors constantly compare policy paths across major central banks, including the US Federal Reserve and the European Central Bank. Differences in interest rates influence where capital flows, how currencies move, and how global financial conditions evolve. The BOE's move adds to a broader global debate. When is it safe to begin easing after a period of high inflation? Markets are watching whether this signals a wider shift or a cautious, country-specific adjustment. Section 6. Risks and what could go wrong. There are clear risks. If inflation proves persistent, easing policy too soon could force the Bank of England to reverse course later, damaging credibility. On the other hand, keeping rates too high for too long risks deepening economic weakness or triggering recessionary pressures. This is why central banking is often described as a balancing act. Small policy mistakes can have outsized economic consequences, which is why markets react strongly to even cautious changes. Section 7. What investors and businesses should watch. Attention now shifts to what comes next. Investors and businesses will monitor inflation trends, wage growth, consumer demand, and signals from future policy statements. They will also watch how other central banks respond, as coordinated easing or divergence can reshape global markets. Whether this cut marks the beginning of a broader easing cycle or a temporary pause will depend on how economic data evolves in the coming months. Conclusion. So this rate cut is more than a headline. It reflects easing inflation pressures, rising growth concerns, and a cautious shift in global monetary policy. Central banks are entering a sensitive phase where every decision carries consequences beyond national borders. If you want calm, fact-based explanations of global finance, without hype or misinformation, subscribe to Economic Global Brief. This is just the beginning.